So I came across this really interesting piece of content recently. It's under the Financial Times Opinions column, and it's written by this guy called David Zervos, and he's the chief market strategist at Jefferies, one of Wall Street's major global investment banks. And the title of his piece, Investing Naysayers Have Let Gloom Override Judgment Under Donald Trump, unquote. Now, regardless of where you sit politically, I think he's hitting on something far more important. And it's really about the idea around how easily emotions creep into our investing process and how fear-driven narratives can completely cloud our rational judgment. And just think about the headlines we've seen over the past few months. The Trump administration's tariffs are setting us up for stagflation. The dollar's global dominance is collapsing. And this is the end of the American exceptionalism. And be honest with yourself, were you spooked by any of these headlines too? And yet, while everyone was focused on the doom and gloom, the market quietly staged a rebound. Which brings us to the real question. Are investors once again falling into one of the oldest traps in the market, letting fear override everything? Because as David argues, when you zoom out and study the larger focus at play, history may actually be setting us up for something far more powerful. And we could be standing at the early stages of a new multi-decade bull market. One that echoes the massive supercycle we saw back in the 1980s and 90s. Let's dive right in. Legendary investor Warren Buffett famously said, "You've got to check your emotions at the door." But let's be honest, how many of us actually do that? And in April of 2025, we saw a textbook case of how emotions hijack our investment decisions. Headlines screamed, recession ahead, bond market collapsing, Fed trapped. And right on cue, many panicked and dumped stocks at exactly the worst possible moment. And do you know what's the worst thing you can do now? Not hitting the like button. So you can right that wrong by tapping on it now. And after that sharp sell down, what happened next? Within just a few weeks, the S&P 500 rebounded nearly 20% off the April lows. Now, if you're scared during that period, don't worry, you're definitely not alone. Even the so-called smart money on Wall Street, they were also caught up in the same trap. The macro hedge funds just recorded their worst start to a year on record. And Bank of America's Fund Manager Survey actually shows that US equity allocations are now at their lowest since May of 2023. And in simple terms, it means that many of these so-called professional portfolio managers are currently underweight US stocks or US equities, and they are definitely now underperforming the index. In fact, if you pull up the Delbar annual study, which actually tracked investors' behavior for decades, the data is actually quite clear. It shows that the average equity fund investor underperforms the S&P 500 by 3 to even up to 5 percentage points per year. Not because they pick terrible stocks, but because they can't sit still when emotions run high. And this is probably why you often hear the phrase, the market climbs on a wall of worry. Stocks, as an asset class, sometimes just feels like a cat with 9 lives. No matter how pessimistic the headline sounds, the markets somehow keep finding new ways to match new all-time highs, especially for strong resilient companies that are able to adapt and weather through any crisis. So what does all of this have to do with where we are today? Well, sometimes history doesn't repeat exactly, but it does rhyme. And if you start connecting the dots, you'll realize we may actually be staring at the early signs of a new supercycle that could rival what we saw back then. And if you enjoy this kind of breakdown, where we take a step back from the noise and really study the nuances that shape up the market, and that's exactly what we try to do every week with our free investing newsletter called Investing Bites. So every issue is designed to give you short, real-world examples that help you build a better investing framework. And if that sounds like something up your alley, hit the link in the description below and we'll send the latest issue straight to your inbox. Now, let's get back to the video. So in the early 1980s, President Reagan ushered in sweeping policy changes. Top marginal tax rates were slashed from 70% down all the way to 28%, while deregulation across industries like airlines, trucking, and the banking sector unleashed a wave of corporate profitability. Inflation, which has also peaked nearly 14%, was crushed below 4% by the end of the decade. So with a stronger earnings and a stable economic backdrop, stocks basically exploded to the upside, of course. The Dow Jones nearly tripled between 1982 and 1989, and that's only the first phase. Subsequently, we entered into the 1990s, and a second powerful force took over: the rise of the internet, which fundamentally reshaped industries. They drove efficiency and they created entirely new business models. And the Nasdaq, it exploded nearly 800% from the 1990s to the 2000s, delivering extraordinary gains for those who saw the opportunity early. Today, we're starting to see something surprisingly familiar, which echoes the powerful eras of the 1980s and 90s. On the policy front, governments are shifting towards much more business-friendly reforms. We have seen major fiscal incentives like the Chips and Science Act, and it's a $280 billion commitment, and it's aimed at reshoring semiconductor manufacturing. And a large part of President Trump's second agenda, other than tariffs, is centered around deregulation and of course the slashing of taxes. Meanwhile, on the technology front, we may be witnessing the early stages of a productivity revolution, one that could even rival that or surpass what the internet has achieved in the 1990s. So AI, or artificial intelligence for short, isn't just a tech fad. It's rapidly moving into broad adoption across industries like healthcare, finance, logistics, services, and even manufacturing. And according to McKinsey's 2023 report, generative AI alone could add between 2.6 to 4.4 trillion annually to global GDP once they've been fully implemented. And further upstream, Bank of America estimates that global AI infrastructure investment, which includes things like data centers, chips, software, and supporting hardware, could surpass $1 trillion by 2027 alone. And they're fueling not just tech companies, but entire supply chains around semicon, energy, and even industrial automation. And perhaps the most interesting of them all, many investors still aren't fully pricing this in, distracted by political headlines and short-term macro noise. So supply-side reforms and productivity gains can lead to a disinflationary growth, fueling a potential supercycle. Now, to be clear, no one can predict exactly where the markets will go next. Markets are complex, they are forward-looking, and they continuously incorporate new information that none of us can fully foresee. But what we can do as individual investors is to focus on how we approach and prepare ourselves to participate in the long-term performance of the market. First, separate headlines from fundamentals. The market will always be filled with noises. Political events, central bank speculation, recession prediction. These narratives constantly change. They change weekly, sometimes even daily. But what tends to matter more over a multi-year cycle is the underlying engine of earnings growth, productivity improvements, and capital formation. Historically, businesses that can adapt, innovate, and compound profits over time tend to be the ones that monopolize and drive stock market returns. And my case in point here. Second, understand where long-term growth drivers are forming. While past decades had deregulation and the internet as structural drivers, today we are seeing areas like AI, automation, industrial reshoring, and energy transition emerge as potential productivity boosters for the broader economy. So these are areas investors may want to research further, not necessarily just to jump right into it immediately, but to stay educated on where long-term transformations could take place. Third, think in terms of time horizons and portfolio balance. So long-term investing often rewards patience, but it's also important to manage diversification and risk tolerance according to your own private circumstances. Fourth, avoid anchoring to short-term fear or even euphoria. There is a lot of data from history showing that some of the strongest bull markets often begin when sentiments feels uncertain. So the goal isn't to try to time the market perfectly, whether to time the top out of your exit or time the bottom for your entry. It's more so to avoid being overly influenced by short-term emotional swings. And finally, stay curious and have that hunger to learn. Economic environments evolve, new industries rise, and old ones fade to the background. What remains constant is the need for ongoing education. So you probably want to read widely across research, across macro trends, sector developments, and corporate fundamentals across different industries. And all these will help sharpen your thinking over time. So the real challenge for most investors today is not about predicting exactly when or how these forces will play out. It's about having a clear framework, staying rational, and allowing for all these longer-term themes to unfold without being thrown off by the inevitable short-term noise that comes in every market cycle. So I wish you the best of luck and I hope to see you investing profitably in this current super cycle. And this is CK from Piranha Profit signing off. Till next time, keep winning.